Did you know that not getting a college degree could cost you something like $500,000 over your lifetime?
Yeah. Yeah.
And that one MIT economist actually called a college degree, quote, cheaper than free.
Cheaper than free. That
Yeah.
really makes you stop and think, doesn't it? What does that even mean?
It absolutely does.
Hmm.
And it's not just some random number. It points to something really fundamental about how our economy works.
Right.
So today, we're doing a deep dive into how that kind of figure gets determined. More broadly, we're looking at how the prices of essential resources like your labor, land, machines, capital, how those prices are actually set.
Yeah, and we're digging into a key chapter on factor markets and income distribution from Paul Krugman and Robin Wells's Microeconomics. It's the 6th edition we're looking at.
Our mission here is really to unpack these sometimes intimidating economic ideas, make them clear, show you why they matter in the real world.
And hopefully give you some solid insights, whether you're studying this stuff or just trying to understand, your own economic prospects. We'll hit the basics of supply and demand for inputs, why wages can be so wildly different.
And that crucial idea of human capital, which ties right back to that cheaper than free college degree concept.
Exactly. So expect, hopefully, clear explanations, some interesting real-world examples, and maybe a new way to think about income and opportunity.
Okay, let's get into it. That staggering value put on a degree, it's not decided by some committee somewhere, right? It's the market. So what are these factor markets?
Well, it's actually pretty neat. Just like you have markets for, say, coffee or smartphones, the things you buy,
Right.
there are these parallel markets for the inputs used to make those things. Those are the factor markets. And the prices decided there, those are factor prices. They're kind of the hitting markets behind everything else.
Okay, inputs. So what are the main factors of production, as economists call them, that are being bought and sold in these markets?
Traditionally, economists group them into 4 main categories. First, there's land. And that's not just, fields or plots. It's really all natural resources.
Got it. Like oil, timber, water.
Exactly. Then you have labor. That's pretty straightforward, the work people do. Third is physical capital. Think machinery, buildings, computers, tools, the manufactured stuff used to produce other stuff.
Okay.
And finally, and this one's increasingly vital, especially today, is human capital. This is the improvement in labor that comes from education, skills, knowledge, experience. It's embodied in the workforce. Krugman and Wells really stress how technology is making this more and more important.
That distinction feels really important. Physical tools versus the skills in people. But hang on. What makes something a factor of production versus just any other input, like the electricity we're using right now, or maybe the steel used to make a car? Aren't those inputs too?
That's a really good question, and it trips people up sometimes. The key difference, the sort of defining feature, is that a factor of production earns income from selling its services repeatedly over time.
Okay, repeatedly.
Right. So a worker provides labor day after day. A machine can be used for years. Their service is ongoing. But inputs like electricity or steel, they get used up entirely in the production process.
I see. Once the electricity is used, it's gone. It can't generate future income for whoever owned it.
Precisely. It's that ability to be a recurring source of income that defines a factor like labor or capital.
Okay, that clarifies things. So how do these factor markets actually work to allocate resources? Can you give us a real-world example of this in action?
Yeah, let's look at the bigger picture. Think about that oil boom in Midland, Texas a few years back, say 2016 to 2019. Employment just exploded. They're like 24% growth, way higher than the national average.
Wow.
And it wasn't just oil jobs. The demand for oil workers was so intense, it drove wages sky high. And that pulled other workers in. Get this. Barbers willing to move to Midland could apparently earn up to $180,000 a year by 2019, just cutting the hair of all these newly well-off oil workers.
$180,000 for a barber. That's incredible.
It really shows how the market, through high wages, the factor price for labor, in this case, signals where resources are needed most urgently. It pulls people, pulls labor to where the demand is strongest.
That's a fantastic illustration.
Yeah.
So these factor prices don't just move people around. They have a bigger impact too, right? Why else do they matter so much?
They matter profoundly because they determine the factor distribution of income. That's the fancy term for how the total income generated by the entire economy gets divided up. Who gets what share?
Okay.
So in the U.S. in 2019, for instance, nearly 70%, about 68.9% of all income went to compensation of employees. That's wages, salaries, benefits, labor share, essentially.
Lion's share, really.
Definitely. And it's crucial to remember, like we said, a lot of that isn't just payment for basic work, it's a return on human capital. Think of a surgeon's salary, it reflects years of incredibly specialized training.
Right. So if we imagine the economy's income as a pie chart, like figure 19:1 in the book describes, labor gets almost 70%. The rest is split between proprietor's income, which is a mix of labor and capital for small business owners.
Rental income, corporate profits, and net interest. Yeah, that's the basic breakdown.
And this division isn't set in stone, right? It changes over time.
Oh, absolutely. The book gives this great historical example from the For Inquiring Minds box, the Industrial Revolution in England. Huge shift. Before, land was a major source of income for the aristocracy.
Right. Think Jane Austen novels. Landowners.
Exactly. Around 1800, land generated about 20% of income. But as industry took off, capital factories, machines became way more important. By 1850, land share dropped to 9%, while capital share rose from 35% to 44%.
So the economy fundamentally changed who held the wealth and power.
Totally. And you see it in literature. 50 years after Austen, you get Charles Dickens writing about factory owners, industrialists, financiers. The factor distribution of income literally reshaped society and the stories people told.
That's fascinating. Okay, so factor prices set by supply and demand. Let's focus on the demand side now. How does a typical firm trying to make a profit decide how much labor or land or capital to actually employ?
The core idea here is something called the value of the marginal product, or VMP. It sounds technical, but the concept is pretty intuitive.
Okay, break it down.
A firm considers hiring one more unit of a factor, say one more worker. They ask two questions. How much additional output will this worker produce? That's the marginal product of labor, MPL. And second, what's the value of that extra output? So they multiply the MPL by the price P they get for selling the output. VMPL equals P times MPL.
Got it. The extra stuff produced times the price of that stuff.
Exactly. And the rule for profit maximization is simple. Keep hiring more of a factor as long as the value it adds, the VMP, is greater than or equal to its cost, like the wage rate for labor.
Can we use that wheat farm example from the chapter, Riley and Tyler? How do they apply this?
Sure. Let's say wheat sells for $200 a bushel, and the wage for a farm worker is $200 a day. Riley and Tyler look at table 19.2. Hiring the first worker adds 19 bushels worth $380, way more than the $200 wage. Good deal.
Makes sense. Keep hiring.
Yep. The second worker adds 17 bushels, $340 value. The third adds 15, $300. Fourth adds 13, $260. Fifth adds 11, $220. All profitable hires because the VMP is above $200.
Okay.
But the sixth worker, due to diminishing returns, maybe they start getting in each other's way, or there isn't enough equipment, the sixth worker only adds 9 bushels. That's only $180 in value. Hiring them would cost $200, but only bring in $180. That would reduce profit.
So they stop at 5 workers.
Exactly. They hire up to the point where VMPL equals the wage rate. And this VMPL curve, which slopes downward because of diminishing returns, as shown in figure 19-3, is the firm's demand curve for labor. It shows how many workers they'll hire at any given wage.
Okay, that makes sense. So the firm's demand curve for a factor is just its VMP curve. What then causes that whole demand curve to shift? Like what makes them want more or less labor at every wage?
Right. Good question. There are 3 main things that shift the factor demand curve. First, changes in the price of the output. If the price of wheat suddenly jumps to $30 a bushel, then the VMP of every worker goes up because P is higher in PXMPL. That shifts the entire VMPL curve upward, like in figure 19-4.
Yeah.
Riley and Tyler would now want to hire more workers, even at the $200 wage.
Okay, higher output price means more demand for the input. Makes sense.
Second, changes in the supply of other factors. Imagine Riley and Tyler acquire more land. Now, each worker has more land to cultivate, making them potentially more productive. Their MPL increases. So VMPL, PXMPL increases, shifting the demand for labor upward again. More land makes labor more valuable.
Interesting interplay there. And the third?
Third is changes in technology. This one's tricky because it can go either way. Think about automation, Matthew. New tech might replace some manual labor, reducing demand, like cars replacing horses and blacksmiths.
Right.
But technology often increases labor productivity, too. Better farming equipment, better software. These can raise the MPL of workers who use them, increasing the demand for skilled labor. In the U.S., over the long run, technological progress has generally been a major driver, increasing the demand for labor by boosting productivity.
Okay, so we've gone from one farm's decision to the factors that shift demand. Now, let's zoom out to the whole market for, say, labor. How does this VMP concept determine wages across the entire economy?
Well, in a competitive market, all firms essentially face the same market wage for a given type of labor. Each firm hires workers up to the point where their VMPL equals that market wage. So, in equilibrium for the whole market, the wage rate ends up equaling the equilibrium value of the marginal product of labor.
So the market wage reflects the value added by the last worker hired somewhere in that market.
Pretty much, yeah. You can visualize this with a standard supply and demand graph for the labor market, like figure 19 to 6. The market demand curve is just the horizontal sum of all the individual firms' VMPL curves. The supply curve slopes upward, showing more people are willing to work at higher wages where they intersect. That gives you the equilibrium market wage, W star, and the total level of employment, L star.
And this applies to land and capital too.
Yes, same logic. Their rental rates, the prices paid for their use, are determined by their equilibrium marginal products as well. The supply curves might look different, though, as figure 19 to 7 shows. The supply of land is often considered pretty fixed, so it's a steep curve. The supply of physical capital is usually more responsive to price, so it's flatter. But the demand side is driven by VMP in both cases.
Okay, this marginal productivity theory, it sounds very neat, very logical, but you look around at the real world and wages are all over the place. Huge gaps exist. Does this neat theory actually hold up, or is it missing something big?
That's the million-dollar question, isn't it? And you're right to be skeptical. While the theory is a really powerful benchmark, the real world is messy. Two big criticisms, or maybe nuances, often come up.
Okay, what are they?
First, those large income disparities you mentioned, often along lines of gender, race, ethnicity. Does the theory just imply these groups have vastly different marginal productivity? That feels uncomfortable and maybe incomplete.
Yeah, that's a tough one.
Second, there's a danger some people mistakenly interpret the theory as saying the existing income distribution is somehow morally justified or fair because it reflects productivity. But the theory is descriptive, not prescriptive. It aims to explain how markets determine income, not whether that outcome should be considered fair. That's a separate ethical question.
Right, it describes what is, not what ought to be. Okay, so let's tackle those disparities. How much of the wage gap can be explained by factors consistent with the marginal productivity idea?
Well, a surprisingly large chunk, actually, when you dig into it. Several factors fit within the theory's framework. One is compensating differentials. Basically, jobs that are less pleasant, more dangerous, or more stressful often have to pay more to attract workers.
Like the hazardous load truckers you mentioned.
Exactly. Or think about essential workers during the pandemic getting hazard pay. The higher wage compensates for the added risk or unpleasantness. The theory would say that wage equals the VMP of the last worker willing to do that specific, less desirable job.
Okay, so differences in the job itself. What else?
Differences in ability or talent. Some people are just exceptionally good at what they do. Think superstar athletes like Serena Williams or top performers in any field. Their VMP is astronomically high because their talent is rare and generates huge value. The theory predicts they'll earn enormous amounts.
Makes sense. Unique talent, unique VMP.
And third, probably the biggest one in the modern economy, differences in human capital. This is massive. People with more education, specialized training, years of experience like, say, a neurosurgeon versus a general laborer, typically have a much higher VMP.
Because their skills make them more productive.
Precisely. And figure 19 to 9 in the text really drives this home. It shows median earnings across different education levels for various demographic groups. The pattern is crystal clear. More education equals significantly higher earnings, regardless of gender or ethnicity.
So differences in education levels do explain a significant part of observed wage gaps between groups.
They explain a substantial portion, yes. Things like historical differences in access to education, occupational choices influenced by societal factors, career interruptions, differences in hours, these human capital-related factors account for a lot of the variation we see.
Okay, so compensating differentials, ability, human capital, those fit the model. But what about factors that seem to break the mold of a perfectly competitive market? Things that aren't just about VMP.
Right. And those are definitely present, too. Several forces can create wage disparities that deviate from the simple VMP equals wage rule. First, you have market power. This can be on the worker's side or the employer's side.
Like unions?
Exactly. Unions use collective bargaining to push wages above what the competitive market might otherwise set. Data shows union members consistently earn more, the book cites over 20% more in 2019 than similar non-union workers. Unions can also compress wage gaps within firms.
Okay, worker power. What about employer power?
That's called monopsony. It's when there's only one major employer or maybe just a few in a particular labor market. Think of a classic company town, or maybe an area with only one hospital system.
Ah, so workers don't have many alternatives if they don't like the wages offered.
Precisely. This gives the employer power to pay workers less than their VMP. The book uses the example of nurses. Their median pay might be around $72,000, but in a truly competitive market, their skills might command $90,000 or even up to $200,000. The lack of employer competition holds wages down.
Wow, that's a huge potential difference. Okay, market power. What else?
Another interesting one is efficiency wages. This is when employers choose to pay workers more than the market equilibrium wage.
Why would they do that? Does that hurt profits?
Not necessarily. They do it strategically.
Hmm.
Higher wages can motivate better performance, reduce costly employee turnover, and attract a higher quality pool of applicants, especially in jobs where it's hard to monitor effort directly, like, say, a nanny or certain types of creative work. Paying a premium makes the job more valuable to the worker, encouraging them to work harder and stay longer.
So it's an investment in productivity and loyalty, basically.
Exactly. But it can also lead to a surplus of workers wanting those jobs, causing some unemployment for people qualified but unable to get hired at that above market wage.
Okay. And the last factor, deviating from pure VMP.
Discrimination. This is where workers are paid less or have fewer opportunities simply because of their gender, race, ethnicity, or other group characteristic, not because of productivity differences.
Doesn't the market work against that? Wouldn't a non-discriminating firm hire those workers cheaper and outcompete others?
In a perfectly competitive world, yes, that pressure exists, but discrimination does persist. It often gets entrenched when markets aren't perfectly competitive, like under monopsony, where the employer has a pool of applicants to choose from and can afford to indulge biases. Also, historically, government policies sometimes institutionalize discrimination, like segregated schooling, which had long-lasting effects on human capital accumulation for affected groups. Past discrimination casts a long shadow.
So it's complicated, lots of factors beyond just simple VMP.
Yeah.
Yet you're saying the VMP theory is still useful.
Absolutely. It provides the essential baseline. Think about that help wanted at Flex example in the book. Flex is this huge manufacturer. They pay skilled machinists maybe $73,000 a year, but the average value added per worker is way higher, like $270,000.
Yeah.
Seems like a huge gap, right? Like they're underpaying based on VMP.
Yeah, it looks like it on the surface.
But the theory helps us unpack it. First, remember, firms pay based on the VMP of the last worker hired, which is lower than the average VMP due to diminishing returns. Second, that $73,000 is just the wage. You have to add in benefits and, crucially, the massive cost of training these skilled workers, sometimes over $100,000 per trainee. When you factor in the total compensation costs and the marginal, not average, VMP, the numbers often align much more closely with the theory.
Ah, okay, so you have to look at the full picture. Marginal value and total compensation.
Exactly. And this links to why some systems work well. Like the German way mentioned, their strong apprenticeship programs and works councils boost human capital and worker involvement, allowing firms to sustain high-quality manufacturing and high wages. It's consistent with VMP when human capital is high.
Or that minimum wage puzzle idea.
Right. If employers have monopsony power and are paying below VMP, a minimum wage hike might just bring the wage closer to VMP without forcing layoffs. The hiring might still be profitable. It really depends on the starting point relative to productivity.
Fascinating stuff. Okay, we spent a lot of time on the demand side, how firms decide who to hire. Let's flip it now. Let's talk about the supply of labor. How do you, as an individual, decide how many hours to work?
Fundamentally, it boils down to a time allocation decision. You have a limited amount of time, and you have to choose how to split it between work, which earns you income to buy stuff, and leisure, which is basically any time not spent working.
And leisure isn't just being lazy, right? It's valuable time for rest, family, hobbies.
Exactly. Economists generally treat leisure as a normal good, meaning people want more of it as their income increases.
Okay, so here's the tricky part. If your wage rate goes up, do you automatically work more hours? Because, each hour is worth more now. Or do you work less because you can afford more leisure?
That's the crux of it. It's not obvious because two effects are pulling in opposite directions.
Okay, what are they?
First is the substitution effect. A higher wage makes leisure more expensive. Why? Because the opportunity cost of taking an hour off the income you give up is now higher. So this effect incentivizes you to substitute work for leisure, meaning work more hours.
Okay, higher wage makes leisure pricier, so work more.
But then there's the income effect. A higher wage also makes you richer overall. And since leisure is a normal good, being richer makes you want to buy more leisure. This effect pushes you to work fewer hours.
Ah, okay. So higher wage makes you richer so you can afford to work less. They really do pull opposite ways.
They do, and the net result depends on which effect is stronger for you at a particular wage level.
So what does the individual's labor supply curve look like?
It can actually slope upward or downward. If the substitution effect dominates, the lure of higher pay per hour outweighs the desire for more time off, your supply curve slopes up.
Yeah.
You work more as wages rise. But if the income effect dominates, you value the extra leisure more than the extra income from working more, your supply curve can actually bend backward and slope downward. Higher wages lead you to work less. This is called the backward bending labor supply curve, shown in figure 1910.
Interesting. So someone might work more hours when their wage goes from $20 to $30, but maybe cut back hours if it goes from $100 to $120.
Exactly. At lower wage levels, the substitution effect often dominates you need the money. At higher wage levels, the income effect might become more powerful. You can afford more time off.
And hasn't this played out historically? Haven't people generally worked fewer hours as wages have risen over the long term?
Yes, that's a key observation. Over the last century or so in the US, real wages have increased dramatically, but the average work week has gotten shorter and people tend to retire earlier. It suggests that, on average, Americans have used some of their increased wealth to purchase more leisure time. The income effect seems to have been quite strong overall.
Okay, that's the individual choice. What about the market labor supply curve? What makes the total supply of labor in the economy shift?
Several broad factors shift the entire market supply curve. First, changes in preferences and social norms. Think about the huge increase in women participating in the paid workforce since the 1960s. That was a massive rightward shift in the labor supply curve, driven by changing attitudes and opportunities.
A huge societal shift.
Definitely. Second, changes in population. More people generally means more potential workers, shifting supply right. Immigration is a key part of this. Third, changes in opportunities. If, say, lucrative jobs open up in tech, it might pull workers away from other sectors, shifting the labor supply left in those other areas.
Right.
And fourth, changes in wealth. If there's a big stock market boom or rising home values making people feel wealthier overall, they might choose to retire earlier or work less, shifting the labor supply curve to the left. It connects back to that income effect on a macro scale.
And policy matters too, right? Like the book mentions childcare costs.
Oh, absolutely. The source points out that relatively high childcare costs in the U.S. likely depress the labor supply of women, especially mothers, compared to countries with more subsidized childcare. Policy choices directly impact these supply decisions.
Okay, let's try and pull all these threads. VMP, market power, supply choices together with that Walmart business case. It sounds like a really dramatic turnaround.
It really is a fascinating case study. America's biggest private employer, right?
Yeah.
Historically, they had this reputation: low wages, unpredictable schedules, minimal benefits.
Yeah, not exactly a model employer image.
And it wasn't just employee morale. They faced lawsuits, sure, but critically, customers were unhappy. You heard constant complaints about messy stores, empty shelves, long checkout lines. One analyst said it bluntly: if an item is not on the shelf, then you cannot sell it. By 2015, things were bad. Only 16% of their stores were meeting basic customer service goals.
Ouch. So sales must have been suffering too.
They were. So in 2015, they initiated a major strategic shift. They started by raising wages significantly. Average pay for frontline workers jumped 16% by 2016. They also focused on giving people more predictable schedules.
It didn't work.
The results were pretty striking. Customer satisfaction scores climbed. By 2016, 75% of stores were hitting those service targets, a huge improvement. And crucially, Walmart's sales growth, which had lagged competitors, started picking up again.
So investing in workers paid off on the bottom line, and they didn't stop there.
No, they kept going. In 2018, another starting wage hike, new bonuses, and significantly expanded benefits like 10 weeks of fully paid maternity leave. The book calls these sticky benefits.
Sticky, meaning?
Meaning they make it much harder, much less attractive for employees to leave. They reduce turnover, which is really expensive for companies. They also invested heavily in training, setting up Walmart academies, and boosting their e-commerce integration, like click and collect services.
Okay, so what's the big lesson here from an economic perspective? Connecting back to factor markets and income.
I think it's a powerful, real-world example of these forces at play. You could argue that initially, Walmart might have been using some monopsony power paying workers less than their potential VMP due to limited competition in some local labor markets.
Right.
But eventually, the consequences poor customer service, lost sales, maybe increased competition from places like Amazon forced them to recognize something crucial. Investing in their human capital through higher wages, better benefits, and training wasn't just an expense, it was necessary to boost productivity, reduce turnover, improve the customer experience, and ultimately increase profitability. It shows that even for a giant like Walmart, the value workers create their VMP and competitive pressures eventually push towards better compensation and investment in people.
So even if markets aren't perfectly competitive, these underlying economic forces related to productivity and value still assert themselves.
Exactly. It might take time or pressure, but they matter.
Okay, we've covered a lot of ground, from factor markets to VMP, wage gaps, labor supply, and the Walmart case. What's the main takeaway for someone listening trying to navigate their own career and economic path?
Well, we've seen that factor markets, driven by supply and demand, are fundamental in setting the prices for labor, land, and capital. This process shapes how income gets distributed. And while that neat marginal productivity theory gives us a core framework,
The real world adds layers of complexity: compensating differentials, huge differences in human capital, market power from unions or monopsony employers, efficiency wages, and unfortunately discrimination, they all muddy the waters and create the disparities we see.
right. But even with all that complexity, the core principle holds a lot of weight. The value you create in the market, your marginal product, heavily influences your earning potential. Understanding these dynamics helps you make smarter choices about investing in your own human capital.
Which brings us back to where we started, that potentially cheaper than free college degree or any investment in skills and knowledge that boosts your productivity and value.
Exactly. So maybe a final thought for everyone listening as you consider your own path. How might ongoing technological changes, AI, automation, whatever comes next, specifically alter the value of the marginal product in the field you're interested in?
And maybe more importantly, what steps can you start taking now to build skills, gain experience, and adapt, ensuring your human capital remains highly valued and competitive in the economy of the future?
That's the challenge and the opportunity.
Indeed. Well, thank you for diving deep with us today into the world of factor markets and income distribution. We really hope this exploration has given you a clearer, more practical understanding of these powerful economic forces.